we are tracking a pivotal moment for US monetary policy, a major leap in the global tech rivalry, a billion-dollar bet in Europe's candy industry, and Saudi Arabia's quiet but steady rise on the world innovation stage. And later, we'll break down what the Fed's latest move really means for gold, the dollar, and investors worldwide. Welcome to Finance Pulse, and here are the top headlines of the day. The Federal Reserve has cut interest rates for the first time this year, lowering borrowing costs by 0.25 percentage point. The move brings the benchmark rate down to a range of 4% to 4.25% and signals that two more cuts are likely before the year ends. It was not a unanimous decision. Newly appointed Fed Governor Stephen Miran had pushed for a deeper cut of 0.5 percentage point. Meanwhile, the battle for AI supremacy just intensified in Beijing. Huawei unveiled what it's calling the world's most powerful AI chip cluster, the Atlas 950 SuperCluster. Built on its in-house Ascend chips, the system is designed to rival the computing power of US giant Nvidia, with Washington restricting China's access to advanced semiconductors. Chinese firms are responding by pooling vast numbers of less efficient domestic chips to reach similar performance levels. In Europe, Mars, the maker of M&Ms and Skittles, is placing a billion-dollar bet on growth. The candy giant announced plans to invest €1 billion, or about $1.2 billion, into its EU operations by 2026. The money will go toward boosting manufacturing, developing more sustainable practices, and accelerating innovation. Mars already employs 25,000 people across 24 factories in 10 EU countries, and this new push adds to the €1.5 billion it has invested in the region over the past 5 years. And in the Middle East, Saudi Arabia continues its steady march toward becoming a regional tech hub. The kingdom has climbed to 46th place in the UN's Global Innovation Index, up one spot from last year and 20 places higher than just 4 years ago. Now, let's turn to tonight's deep dive, the ripple effects of the Fed's rate cut on global markets, especially gold. Gold prices slipped on Thursday after reaching a record high of $3,707 announced just the day before. The drop came as the US dollar strengthened, making gold more expensive for buyers using other currencies. Spot gold dipped to $3,653, while US gold futures fell nearly 1% to $3,688. This decline may sound modest, but it highlights the delicate relationship between interest rates, currencies, and safe haven assets. Here's the dynamic at play. Lower interest rates typically make gold more attractive because it doesn't yield income like bonds of savings accounts. So the opportunity cost of holding it goes down. But when the dollar gains ground, it offsets that advantage for international buyers, creating short-term pressure. Federal Reserve Chair Jerome Powell described Wednesday's cut as a risk management move in response to a weakening labor market. He emphasized that the Fed will decide on future cuts on a meeting-by-meeting basis, adding more uncertainty to the outlook. Despite the pullback, gold has surged 39% this year, building on a 27% gain in 2024. Geopolitical tensions, central bank demand, and expectations of further Fed easing have all fueled its climb. In India, for example, investors are holding on to their gold jewelry and coins rather than cashing out, betting prices will keep rising. Meanwhile, silver, platinum, and palladium showed mixed movements, reflecting broader volatility in the precious metals market. The bottom line, the Fed's decision may have provided short-term support to the dollar. But the bigger story is that gold remains a magnet for investors seeking shelter in an uncertain world. As long as the outlook for jobs, inflation, and global stability remains unclear, that story isn't changing anytime soon. That's all in Finance Pulse for today. Follow the Finance 360 for more updates.